We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back, everyone. Hope you guys are having a great day or week so far. Today is Wednesday, and yeah, we're halfway through the week, or we're more than halfway through the week at this point. So let's get down to it. You can see timestamps in the description below for your convenience. It should give us a schedule to go off of. Of course, we can go off on tangents. Full liberty to do whatever I want on the show. I have a poll that I'm going to give you guys just a couple minutes to kind of answer through. In effect, it will be part of the first topic that we're beginning now, and we're just on time, so we can kind of get through this topic. But as you guys can see in front of you, I have Alphabet Class A shares open, and we're going to begin the weekly, I almost said weekly call, the live stream by talking over this. And I think that there's been a lot of back and forth within the club regarding this company. A lot of optimistic views. However, there are some negative views, and it doesn't actually pertain to any business fundamentals. It actually is more of a let's say, cautionary take based off of who else is bullish on this. So, basically the old use of contra indicators. And I myself am among those people that are somewhat concerned by the population of people that are, really excited about Google. So it's a different time than it was back in 2022 when we could be buying into, various companies, solid businesses, Netflix, Meta, et cetera, and many others, CRM. And you had a lot of people just, say, oh, I can't touch that. No, there's no way. It's going to go lower. And we don't really see that just yet. So I'm basically, coming off the bat, not bearing the lead here. We're not at peak pessimism. And that is, let's say, I think quite evident. If you just go on FinTwit, there is at the beginning of it, there was I saw a tweet the other day of someone asking their audience, hey, should I, buy Google? And funnily enough, the comments were mixed. A lot of people saying you should, but I think more people saying you shouldn't. So maybe we're closer towards a pessimistic look. We have 2 lawsuits underway at the DOJ, one of them pertaining to the Apple payments, and then the other one is around the advertising tools and the monopoly they are accusing them of having. So we're going to see the remediation come out in December of 2024, so Q4 of this year, and that presents at least 2 uncertainties. And so when you've been watching, if you guys have been watching Google's price action the past week or so, we've been seeing relative weakness to peers. So Amazon would go up maybe 3% or so, and then Alphabet would be down, or it would start the day off strong-ish. When I say strong, like maybe a percent up, and then would finish the day down. So it seemed like there's not the appetite for Google that there might be for other Mag 7 companies. I almost cringe at saying Mag 7. And we'll be talking about the AI bubble in this, or the lack thereof. We're going to have a more fleshed out conversation about it, because I think it's another one where you kind of throw a rock now and someone on YouTube is claiming AI bubble's popping. A lot of the contra indicators, people who really are silly, they've been saying AI bubble for like 5 or so times this year. They've called it, and each time it was like, oh, it's a buying opportunity. And they're the biggest flip-floppers on the planet. You might know who I'm talking about by me just saying flip-flopper. So let's go over. And by the way, if you guys have any questions, I'm going to be doing my best to look over here at this screen and seeing your question. I'll star it and we can get to it towards the end of the show. If I don't go over your question, you have every right to ask it again, and I will do my best to see it that time, but no promises because I have to, look between the 2 screens. Okay, so let's get started. I will end the poll. I think we have sufficient responses. And if you guys are enjoying yourselves so far, or if you enjoy the live stream towards the end, feel free to like, share, and subscribe. And if you're on Twitter, do the same thing, retweet it, like it, heart it, whatever you like to do. And then same thing on Twitch. So so far we have, I think that is sufficient votes for at least this. I could have waited towards the end of the stream, but we'll end it there. Okay. So we have no at 64%, yes at 35%. Very interesting. So not the split that I thought would be there. I thought actually more people would say no than yes, but we have a feel at least 35% of people said yes. I'm going to assume they're all serious yeses. So with 35% of people who answered, basically stating that Google is dead money, at least for the foreseeable future, let's kind of entertain that. So what does Google have going against it? We have, again, we stated they have two legal issues, legal battles ahead of them. And then on top of that, they have the threat from LLMs, in particular ChatGPT from OpenAI. So I think that for the time being, Google has dominated in search due to one key aspect of behavior. And that's exactly it, behavior. So people, when they want to find out information, they enact a certain behavior. And that actually pertains to, you take your phone and you go on an internet browser, or you go on your computer, you go to internet browser, and then you search. And you're used to doing it a certain way. If that ever were to change and we see a change in behavior, this does present a threat to Google's dominance, because Google has controlled that behavior for quite some time. They are the default verbiage, as how you say when you want to find out something, you say Google it. So the true threat is we need to start observing if behaviors are changing among consumers that actually poses a threat to its walled garden of advertisement. Because, as many people have stated correctly, if you listen to companies such as the Trade Desk, Google has built an impenetrable walled garden around advertising. They control everything from the information coming in. So they know a lot about the individual users, and they know a lot about you. They know exactly what to put in front of you at the right time. And if you want, as a let's say a products company, you want to get in front of the customer that's going to purchase your product, you got to go through Google. It's not really an option that you can just avoid. And frankly, I view Amazon as being, even in some ways, potentially in the future, a really strong contender in this as well for product advertisement. But Google controls many ecosystems. In fact, if you also ascribe to the belief that the internet will consolidate into just a few sites, basically, not a few sites, but a few avenues of navigation, being, like Google itself counts as one. So one way that you access all websites, and then YouTube, Facebook, Instagram, etc., Amazon, this consolidation of the internet, they are poised to really benefit from that. So the argument is that Google controls too much of the processes, from the the bids of ads to the deployment of ads, and so the potential, let's say, action that the government demands of Google is a divestiture, a sell, or some sort of fine that they might be forced to pay. And I think the fine issue is probably on the more likely side. I'd be surprised if they're forced to divest. So if they're forced to pay a fine, let's make up numbers here, $10 billion, that'd be nothing for them. We have a company that has over 110 billion in cash as of the last report, with only 10 billion in debt. So I'll just throw that onto the pile and then move on past that. And that's a catalyst that we might see, but we won't have that till December. And then the other one with regards to Apple is the big question mark. We saw the Apple event come out, and the problem with the Apple event, right, that many people might be concerned of, is this change in behavior that we were just talking about. So if you looked at what Apple Intelligence can do, it seems like it, in the future, if capabilities develop further, it may be able to combat that behavioral shift, or not combat, accelerate that behavioral shift. And something like GPT could become a more defaulted way of searching basic things. So think of it like this. What do you do right now? You're with your significant other and you're like, oh, I want to know what's the good restaurant in the area. So you go on Google and you say good restaurants near me, and you come up with the list. What would happen if the capabilities of something like Apple Intelligence get so good to the point where you could do the same thing there, simply on your iPhone? You ask Siri and it would give you a list. This is something that could end up disrupting Alphabet, and it's not destroying Alphabet. I don't think so at all. I think it's more so about market share at that point. How much market share do they have? Maybe the pie grows still enough where it's not that big of a deal and it's a melting ice cube. So you'd have decaying cash flows, but still really significant. And then over time, the other businesses grow even faster to make up for it. That's another scenario that could occur. And I think actually this one is probably one of the more likely scenarios that could occur, where search is challenged, but the other businesses grow enough or more than enough to circumnavigate that decline. And those businesses are YouTube, which is in some ways the second largest search engine in the world, behind google.com. And with YouTube, you have this massive library with beautiful economics of scale, where something like a Netflix has to spend and plan every piece of content or acquire a piece of content. YouTube just has to sit there and say, here, you guys are watching me on YouTube. This guy is creating videos. It's free for us. We're not paying him a penny. He's having some sort of profit sharing, incentive with us, but we're not directly paying him for his content. He's voluntarily producing content for us, and we're just hosting it. And then you have this massive ecosystem where a bunch of people go to YouTube for entertainment, and it just kind of works together alongside its other businesses, where Google, being part of Google, it has a lot of benefits from the build out that Google has for its compute. Now, on to compute, we have the Google Cloud business. In Google Cloud, this is one of the more exciting businesses, in my opinion. And if you see Google Cloud's growth relative to peers, its peer group being AWS, Azure, and then Oracle's over there, you see that they've actually been growing faster than their peer group. Another point to consider is that recently Google's cloud segment has gone from unprofitable to profitable, right? And so we should see margins continue to expand. Something we've also been noticing is that EBITDA margins are actually accelerating or expanding now. They were contracting for a little bit, but now they're back to acceleration. And so if that trend continues, I think that we're going to maybe change our tune here a little bit. And a lot of that has to do with the cloud business finally being profitable. Now, the counterpoint to what I just said, just a quick counterpoint, because I'd be remiss if I forgot to mention it, that the cloud business may be more profitable because of the accounting changes. That's a counterpoint that I hear often, and that is true. That is not something we can dismiss entirely. However, I do think that their cloud business is also showing signs of increasing scale, and they're finally maturing to the likes of Azure and AWS. And I think that's going to continue. I think they're going to continue to grow into their potential size. And it's going to become one of Google. Well, it's already one of Google's most important businesses, but it can become more important. And over time, we might see some of these other businesses become the same, or if not more important, on a contribution margin ratio relative to search. And if that happens, it's definitely not a dead investment. So the question is, what were the concerns? Who are the contras? Well, if you go on Google, if you go on YouTube and you go on Twitter, you see a lot of people that kind of just throw spaghetti around. They just throw things around, and sometimes they get things right. A lot of times they get things wrong. And a lot of those people, you tend not to feel too secure if they are also bullish alongside you. You get a little bit like, ooh, that guy is in the stock. I think I'm not. So one of them that comes to mind is like Everything Money. Everything Money is probably one of the silliest people on YouTube who invests. And if he's bullish one of your stocks, you should actually, think twice, because potentially, it could go very poorly for you. But he's just like one example. I'll only name him. Everyone else, I'll just keep anonymous. But there's not that same level of pessimism just yet. I think there could be if things progress further. And I think this rally today may be too early to say, it's all over. And if it isn't, I think that's perfectly healthy. We saw a pullback in April, and then we had a subsequent really strong rally. And then I think a pullback here is more than fine. I'm very happy with the performance we've had this year, and a pullback, perfectly welcome. Readjust, redeploy, move on, and we'll see what happens. The exposure to a lot of the names that are actually shielding or flight to safety stocks has been, quite helpful. And the exposure to tech in particular has thankfully been minimized to not the ones that have had a massive correction. In particular, I'm thinking of Amazon, which has shown relative strength. And I don't entirely know why. I think it's because maybe the market's saying they're a staple now, and regardless of the economic environment, they'll be fine. I can't really put my finger on exactly why that is. So let's see here. I'm coming back here to make sure there's not any questions. Or just into warehouse utility. Okay, so interesting opinion. So someone says cloud is an online hard drive as destined to be a warehouse utility / utility. Oh, interesting opinion. Tom Lee, don't miss. I mean, he's just perma bull. So, oh, there's also Waymo. Can't forget about talking about Waymo. So Waymo has actually basically shown Tesla how to be better than Tesla. So the Tesla bulls have been shouting from the rooftops, hey, full self-driving is on its way. Full self-driving is on its way. And then here comes Waymo, and it's like, here's full self-driving. Of course, in select cities, but it works. And it further kind of adds to the argument that Tesla will have to move in the direction of LiDAR if it's ever going to stand a chance against LiDAR. Because it does appear that even if they get it close enough with visual, I don't think regulators will allow a non-LiDAR based system to take the roads. The reason is, well, first of all, if you kind of think about it a little bit, doesn't matter that it's better than, it has to be almost perfect. It doesn't matter that it's better than the average driver. It has to be perfect. Regulators will not allow anything below that. And I know, you might get annoyed by me saying that and say like, oh, but those regulators, those pesky regulators getting in the way of advancements in technology. It is what it is. You can just accept it or deny it, whatever. More than likely, regulators are going to step in and not allow, Tesla have its party. More than likely, it's going to require more stringent controls, and something like a LiDAR-based system will become the standard and the norm. And right now, it's expensive, but it'll probably get cheaper with scale. BYD kind of challenging Tesla in the cheap EV market. I mean, I will defend Tesla there a little bit. That the Tesla's build quality is a little bit is better than BYD's from what I've seen. And I mean, BYD is fine for, a cheap electric vehicle. It does the job. It gets you from point A to point B, and it's fine. But I don't feel that, something like Tesla, I don't think it's a bad car. Of course, I won't bash on Tesla for that. I definitely use GPT over Google these days. Google is trying to put out AI results at the top of the list now too. Yeah, I mean, I personally use Google's LLM a lot for various things. I still use Google, but I use Google's LLM a lot. And I find it actually to be better than GPT's counterpart. So. And okay, so CA has a 1.2 million mile, no incident to be street legal. There you go. I should do driving exam, DMV, LOL. Yeah. Yeah, soon as self-driving and safe, you'll save tons of time and mental energy, not driving, but getting around. Yeah, true. Can't wait for Waymo to drive me around. Yeah, and I know in your place of living, Moxie, I mean, that's going to be the real testament to how these systems can drive. Because, oh my gosh, I mean, when I was in that part of the world recently, I was reminded just like how, there are street laws and then there are laws that the taxi drivers follow. So, so all in all, let me check how we are on the timing schedule. I think that, okay, so we have to wrap up. I think that Google might get even more interesting, but I don't think it's uninteresting here. There's some ways I've been talking with the club members to play Google, and I'm fairly close to fully actioning it at some point in the future. I'm sort of waiting for an additional pullback. The price point at which I found it to be very interesting to add to Google and to build it out would be around 120-ish or so. So we're not too far away. from that. We're a stone throw away, and that would make it very compelling. But I don't blame someone right now for buying. In fact, I think at this price, it's a fair price. If it's a fair price to pay for the risks ahead, that I don't think are going to materialize as much as some people might think. I'm speaking on the litigation risks. So, okay, let's ask a question on this channel without getting banned. That's amazing. Yes, I know what channel you're referencing that bans people, but yes. Okay, great question. When margin calls, that's a great name, by the way. Is Google a business that can survive in confident management? A business so good that even an idiot can run? I think so, because I think management has not been the S tier management for quite some time. I think Satya Nadella is a great CEO, and Sundar Pichai is a okay CEO. So Google 2024 reminds me of Microsoft 98.99. That is, I think, the consensus. Everyone on TV is saying it reminds them of the antitrust litigation. That's how much I got for initially, just below 120. Yeah, and again, I don't know if I'm going to wait exactly for that to execute my trade, but the management is a comment, but Google might randomly just pull some innovation out of its. Not gonna lie, yeah, very true. I mean, it could happen. They have basically a blank check, a cash cow to spend tons of money on. All right, so let's get into the next topic of conversation, which the next one that we're going to be discussing is consumer and Fed weakness, credit crisis, and bad banks. So there's a lot to actually cover here, and it mainly comes around what's the three catalysts that we saw so far in the past couple of weeks. We saw the job openings, the jobs report, and inflation. So what did we see with all three? We saw an increase in the amount of jobless claims. We saw adjustments to the prior figures from the month before, quite a large adjustment, one of the large adjustments in recent history. And recently we saw inflation coming down. So not deflation, but disinflation. So what does that all spell? That all spells, okay, stuff that, hey, we're seeing some sort of slowdown into effect. Now, we also saw Redfin's data for housing. How average homes are going up still in price. And, this may be a little bit of noise, lagging indicator. Perhaps we could, kind of go that direction. But all of this culminates into on the 18th, we have the Fed meeting where it is expected we will get I think right now the expectation is 50 basis points. And the total for the year will be 75 basis points. That's, I think, the current built-in expectation. And the market might freak out if it's more than that. I know that there was like a leak from the Fed. It wasn't from the Fed, but the actual document was from the Fed, but it was leaked. And it appears as though they were talking about emphasizing that they're not lowering rates in their prepared remarks because of credit crisis, and hence why I'm talking about credit crisis. Fed saving the economy. If you guys are new to this channel, that's a very playful title. We don't actually think that. I think all that's like kind of funny clickbaity stuff. But anyways, the Fed itself will, have its meeting on the 18th, and it's much anticipated. So up until then, there could be a lot of, expectations that are built into the markets, and we'll kind of see how the market reacts upon the announcement. If it's more, if it's what's expected, and maybe it's a buy the rumor, sell the news kind of event. Who knows? Longer term, it doesn't matter. So with the banking crisis or the credit crisis that we're seeing, let's talk about that. Let's unpack this a little bit. So Ally Bank had a conference yesterday, and many of you may not have seen this news because it was, I guess, superseded by the Basel III regulations that everyone was talking about yesterday. But Ally had a conference yesterday, and if you weren't paying attention, you might have missed out on the 17% drop in a day. What happened? Well, simply put, it looks ugly. Things are looking ugly out there for auto loans. All right. So you might have watched live streams in the past, Capital Mindset. We've had conversations, discussions around this topic, and mainly had to do with, okay, well, what are the canaries in the coal mine with the economy? One of them is auto loans. So, and then there's another one. We're going to talk about another shit bank. Ally is not a shit bank. Ally is an okay bank. But we're going to talk about a shit bank that I don't know why it's not down a lot on this concern. So we at one point yesterday, JP Morgan was down 7%. So I think all of that Basel III stuff was, taking center stage. And Ally Bank over here was kind of ignored. Credit Acceptance Corp, which is another degen car lender, and I'd say Ally is way less degen. Credit Acceptance Corp is degenerate. They go after low income consumers and people who no one would lend to for crazy rates. So, and Credit Acceptance Corp actually has been a good investment since at least 2008. And there was one super investor who was invested in it. But Ally over here kind of was the canary in the coal mine that just fell dead. And long story short, you can watch and listen to the conference yourself. There was one bit of detail regarding auto loans that things aren't looking too hot. There might be an elevated amount of delinquencies up ahead. Something that really puts into question Ally's portfolio, which is a lot of auto loans. So Credit Acceptance Corp, again, like I said, it moved in alignment with that. And we've also been seeing a rapid increase in CLO delinquencies, and just broad-based concerns around commercial credit for multifamily, for office. So there's a lot of cracks that haven't been filled up yet, and they're still there. And so we can all point to it. We just don't know when it's going to, go kaboom, or if it will go kaboom. It could kind of just ease out. That's a possibility. But at least here, this kind of poses like a question, at least. So if auto loans may be getting hit hard here, what else could get hit hard here? So what other loans that exist out there in the world are worse than auto loans? Well, there's two that come to mind. Subprime credit cards. So credit cards for people with bad credit scores. Because in effect, what you're doing as a bank, if you're giving any meaningful line of credit to someone with very low credit, is you're basically, oh, I love that one, Josh, by the way, buy now, pay never. That's funny. That's true though, but that's funny. I'm going to put up your comments so everyone can see it for the record. Buy now, pay never. So credit cards, buy now, pay later. And then the other one I was thinking of that's just a little more degenerate than credit cards, personal loans. Personal loans. Because with a credit card, there's a bit of dynamic movement that can happen, adjustments. And, typically with a credit card, you don't see many that go to like, if you're, not a reliable borrower, you're not going to get a credit line of $100K. But personal loans. In fact, you guys know of one, the funny man on YouTube, the Michael Scott of investing, if you guys know who I'm talking about, took out a personal line of credit and threw that into Yield Max because he's really smart. And it has like a 22% interest rate. Pretty degenerate, right? So that's the kind of person that's like the last thing you want to lend to, especially in an environment like this. But personal loans, that's the answer to the question I posed. What is worse than a car loan? Personal loans. So then I'm wondering, what companies offer personal loans? What companies have personal loan portfolios? That I would be way more terrified of owning in this environment than a car loan. With a car loan, at the very least, I have something I can take from you, right? In theory. But with a personal loan, what can I take from you? So, and again, it is unknown what someone does with the personal loan. You may have lent it to an utter degenerate, and yeah, okay, you're going to charge him 22%, and he's going to burn it all, and he has nothing, and there's nothing for you to take. Congratulations, you just turned 100K into nothing. I mean, that is in theory why the interest rate on a personal loan is so high, because there's not collateralized. There's nothing for you to take. If you do a mortgage, and you take it out on a home and you don't pay the mortgage, what happens? The bank takes your house. There's collateral. Do the same thing with a car. Subprime credit cards, we doing sale leasebacks now. Subprime credit cards. what I mean by that is subprime borrowers for credit cards. So there's like credit cards that I say I call them subprime because they go after people who have low credit scores. Like they avoid and they have like high interest rates. I'm thinking of like I don't endorse this company. I think that you should. No one here should. You do what you want, but actually, I'm not going to say the company name because I just said what I said. So just out of an abundance of caution, I'm not even going to say the name of the company because I don't know if they'll get pissed off with me saying that. But there's credit card companies out there that have high annual fees, no benefits virtually, and have insane interest rates on their credit cards, and go after it's their market strategy to go after people with low credit scores. And those are the portfolios I don't want anything to do with. JP Morgan, on the other hand, goes after that high end earner, the good credit score person on average. And so their credit card portfolio leans higher credit score. And then let me remind everyone that with credit scores, they don't matter as much with personal loans as they do with credit cards. Wow, mind blowing, right? With a credit card, if I give someone with a high credit score a credit card, it's because they've shown good credit history, et cetera. And the same thing is true when you give them a personal loan. But there's one key difference. When I give someone with a high credit score a credit card is not indicative of a life event that is problematic. A personal loan is. A personal loan has a high correlation with an individual who has had a problematic point in their life. That is why they got a personal loan. They got a personal loan for not good reasons. And so if you have if you've received a personal loan, it's because you don't have other options in front of you. If someone with really good credit and a lot of opportunities in front of, a lot of optionality in front of them, they might have real estate they can borrow against. They might have a credit card offering with 18 months, no interest kind of opportunity with 30, 40,000 credit card limit. I'm sorry, credit card limit. So, or more, actually, you can go even higher, 100,000, depending on your relationship with the bank. So point is, when you receive like a personal loan, yeah, you had a good credit score before, but something happened. Not all the time, not 100% of the time, but it's a higher propensity for that to be the case. So doesn't matter. And I see all these, investors who make it a big deal about, having high credit scores with personal loans. I'm like, you don't know what you're talking about. I know that's like a pitch or like a marketing ploy by them to you as the investor, but yikes, man, you got to think a little bit more within banking. We had a guest on, you guys might remember him, Gary, a long time ago, and we talked to him about that, and yeah, he was in agreement. That's basically, with a personal loan, you gotta be a little bit more nuanced with your analysis and not just blindly apply the same logic to every single banking product. That doesn't make sense. Everything is nuanced. That is one of the main messages of this channel. But yeah, so you guys are guessing it, and this whole discussion, real quick, on banks that might be in trouble right now, is I am very surprised that we haven't seen a move to the downside based off of that Ally conference. I think if you think consumer is weak, the last thing you want to own is a personal loan portfolio. One of the last things you want to own within banking, for sure. Credit cards is one of the businesses that will get hit harder. But if you have a credit card business that tilts towards good credit scores, should be better. You should be better off. But personal loans, oh my, that almost doesn't matter. So you just need a modest tick in unemployment, and yeah, you don't kid yourself, because this is the thing. So a lot of people forget 2008, and many of you were really young. I myself among you. Don't worry, I'm making it sound like I'm an old man with millions of years. But 2008, before 2008, people thought the following: that housing loans, mortgages, would never default, or they would have very low defaults forever. It was impossible for that many defaults to happen. The logic behind that is a house is one of the last things people will stop paying. In your debt, let's say you have a debt portfolio. So you have a lot of things you owe. not like assets for yourself. So not an actual portfolio, but you have these debts in front of you. You have the choices that you have to pay. Money's tight right now in your situation. What are some of the things you're going to stop paying first? I guarantee if you had a personal loan, that'd be number one. Credit card and personal loan, that would be number one and number two right there. Boom. You'd pay the car first before you pay the personal loan. If you didn't, you're silly. But you'd pay the car off first before the personal loan. And then your house will be before the car. Just say. So that's where that comes from. So and it's reflected, by the way, in the risk premium of the interest rates, right? So the interest rates are lower for assets that are considered safer, those with lower delinquency. It's no coincidence that housing loans, mortgages, are of lower interest rate than a car loan, and then a personal loan, on and on and on. So the higher the risk, the higher the interest rate. Makes perfect sense, right? But anyways, kind of taking a step back into it. If you think that consumer's weak, that consumer may have a mortgage. They may have a car loan. And then you're like, they're paying those off. I'll give them a personal loan. And then you make the logical jump in saying, hey, they have these other loans. If I give them a personal loan, nothing bad could happen to me. They have a high credit score. I'm good. I'm A-okay. Good luck. Good luck with that. So HELOC is a bad option. Yeah, home equity line of credit is not. It's like a patch out short term loan. I don't really. I would prefer to do like a cash out refi than a HELOC. But and then there's even other things. If you develop really strong relationship with banks, there's other types of lending products that they can give to you. They're really good. You know, backed on your assets and at really good rates. So it should be like one of your goals is primarily and utmost and foremost increasing your net worth, and then total return should matter. I'm not going to give you that whole spiel. All right, so the next conversation that we're going to have is the AI bubble. We're just in time. By the way, again, any questions? You just leave them. Oh, with all these data breaches, I'm thinking about freezing my credit. No big purchases plan isn't easy, guys. Oh, yeah, that might be a good idea. Oh, we're getting a lot of people saying they stopped using Google for search. And okay, we're at the 40-minute mark. So now time to make Kevin told us to use a HELOC to buy real estate. No, he did? There's no way. Home equity line of credit, a HELOC? Buy real estate? He didn't say cash out refi? A HELOC. Interesting. I don't think I would say that's a good idea, but okay. Tomato. I mean, HELOC has a benefit. Cash out refinance has benefits. I tend to value the benefits of cash out refi more than a HELOC, but that's just me. All right. So the next conversation, AI bubble, is it popping? Well, I think I've heard it from Kevin. He's one of the greatest contras that exist out there because each time he's called like the last 6 recessions or 6 stock crashes, it's been a good buying opportunity. His enthusiasm / bullishness is noise. It's not really a signal of any sort, but his bearishness is definitely a signal, or at least it has been. But his recent, I believe it was last week when we just had like barely a drawdown. He basically did a live stream stating that the AI bubble has popped. And at that point, I had my weekly call with my club members, and we talked about how NVIDIA and any subsequent investment like Arista Networks, etc., things that are adjacent to NVIDIA, they're probably a good add because what we knew at the time, and just looking past the noise, which if anything, he's just like a contraindication to tell you that you should lean harder into this idea. The point on where all of the customers were discussing that we should focus on is cloud or data center spend, and data center spend is remaining the same, if not going up. It's not going down. So, I hold a lot of Taiwan Semi. I hold Arista. The effect or the point that you're kind of listening to with Meta, with Google, with Microsoft, with Oracle is what are we going to do with our CapEx? Is it going down? Is it going up? All of them up, up, and up, or it's the same, but most of them up. So what indication had told us that the AI bubble has popped? We hadn't received one. Only speculation, only fear, only uncertainty. The FUD, that was like actual FUD. And so for the time being, I have no position in NVIDIA, but for the time being, I got to say, I'm not going to call the bubble yet at all. No, we haven't received anything. It's too early to even talk about it. Of course, one day, it's logical to think that the build out will be more than what is necessary, and there will be some sort of correction. That's normal. That happens, and that can be expected. But to say that now is a time, I feel like is a little bit premature, because you haven't received any information. You're just speculating because the stock price went down. You're letting stock price dictate your views, which is the opposite of what you're supposed to be doing in the first place. So anyways, I view individuals like me, Kevin, as perfect contras that you should just keep an eye out. I only listen to them to kind of gauge what maybe should be the opposite of what someone should do. We're talking about an individual who turned 40 million into 10 million within a year and a half. So I feel like that's a pretty good contra if I've ever seen one. And hey, he's got a lot of people who watch him and stuff. He's bombastic, entertaining, and all that, but not really the greatest analyst, investor, or whatever you could call him. So yeah. I feel like, Gil, if you're really following him seriously, I'm sorry to say, but you're maybe more on the you're more on the other the latter than the former. So yes, of course, no, that's definitely if the interest rate on the HELOC can be beaten out by the return on the investment property, it works. You just can't be a degenerate. Yeah, of course. That's with anything. So it's a bet that you're making that the return on the investment will be greater than the cost of capital. I mean, it's the same decision a business makes. You have your hurdle rate, and then you have to earn a rate of return in excess of your hurdle rate. And if you don't, then you're burning money. You might as well light it on fire. So you don't borrow, or you don't have cost of capital at 7% and take on a project that yields 6%. That would be stupid. You take on a project with cost of capital at 7% and it yields 8%, and then you factor in size of the project, because you're not going to take on a project size that's like 0.0001% of your revenue for a 1% return. Makes no sense, because then you have to factor in risk and time value of money, right? We're getting ahead of ourselves, but those are some things you consider. But at on a basic level, yeah, that's with everything. Cost of capital, hurdle rate, that's your hurdle rate. And then you consider the time value and the risk adjustment to that. But anyways, any telecom companies you like? No, I don't like any telecom companies. Okay, so if you follow him for the contra, that's great. Come on, que você agora ASML and TSM. ASML, I'm a bit cautious on right now, but I have them on my watch list for sure. And I kind of want to see how China shakes out. So with China, we could see they already, there's a lot of scrutiny on them. But China, I'm not talking about ASML specifically, but just all equipment. There might be further tariffs in the future, and we might see a reacceleration of orders within China, which could actually boost demand for some of these companies. ASML, I think, has benefited a lot from that China demand increase. They're not able to get their latest machines, but they're able to get some of their older machines. So I think I can more understand TSM's positioning and their dominance. I'm with TSM. I'm not buying it more. I have a lot of it, but I'm holding TSM. So, but good question. Good question. So anyways, in summary, AI bubble, did it pop? Too early to say. I think data center spend is still going strong. My mind is a welcome to change once new information is presented. New information has not been presented. We still have the same information as before. Therefore, if you hear anyone saying on the internet, like a silly person, AI bubble has popped, like me, Kevin, that is probably your contra signal saying that there is more fear right now in the market, and the information, the facts have not changed. You should probably buy. We talked about that in the club. So far, it's looking pretty on point. It may continue to be on point. I think that there's an interesting conversation that we can have towards the end of this that I'll talk about with the whole September thing that everyone's talking about, which almost makes it kind of bullshit now. Pardon my French. But yeah. So let's see how we are on the timing. At the 50-minute mark, we have the Q&A, which I feel like, on an optimistic view of this, we don't have many questions. I answered Ketham's question, but today we don't have many questions. So it seems like you guys are a little dry on questions today, which I think maybe is a good thing. Maybe I answered all your questions inadvertently. But if you guys have any questions, feel free to ask them, and then I'll save them real quick. But otherwise, we're going to go to like a bonus topic that I initially didn't plan on going into. Oh, I see. You guys are hilarious in the comments. Can Meet Kevin fit his whole family onto his small plane? I think so. I think that. Oh no, his family's huge now. Yikes! I don't know anymore. No, I don't think so. I don't even know how big his family is. I think that plane maybe only fits like 8 people. Yeah. It could be problematic. It could be problematic if he were to, but I forget how big his family is. That man's procreating for everyone. We won't have a population problem. Well, there'll be a bunch of his children, his progeny will just like populate the earth. We just have like a nuclear fallout war, and it's just like all Kevin's descendants. That's how he wins. He defeats us all genetically. All right, so bonus conversation. If you guys have been going on YouTube, on Twitter, you might have been noticing a lot of conversation surrounding the September slump. By the way, if you guys are enjoying the live stream, feel free to like, share, subscribe. Reminder. If big trash makes the data centers compete on price, down it goes. If big trash. What's big trash? Big government? Big trash? You mean like literally big trash, like the waste management and all that? Did I talk about NVIDIA? Yes, I did talk about NVIDIA. But I can re-talk about NVIDIA. Let me get through the September schlump conversation real quick, because I think it's kind of entertaining and food for thought. So you've gone on YouTube, you've gone on Twitter, you've been hearing all about this September bad month, and historically, yes, it has been for reasons of outflow of capital and taxes. Yes, absolutely. It's traditionally, statistically has been one of the worst months of the year. And so far, it's no different. September started off pretty bad. We had 2 days last week where the market was down 2%. So taking that into consideration, yeah, it's been a bad month so far. Now everyone suddenly cared about it. And by the way, if you didn't notice, last year, so if I'll just take out some people's one of their favorite ETFs, and I just do the 1 year. What do you notice? October of last year actually was the bottom. We had a sell-off through, I believe it was September and October. We didn't have any rally or respite until the end of October, and then we had the Santa rally. Oh, tech. I see. Sentado. Oh, interesting. I mean, if you're kind of penciling that out, Ketham, I can see the argument for buying ASML here. I mean, it is a monopoly. So if you think that it's the issues I described are nothing burger, ASML has sold off quite a bit. And I think silicon is going to be more important, not less important. But as part of like a overall portfolio, I do believe I remember that you bought it. A question on X. Oh, they added comments on X. That's interesting. How am I tonight? I'm doing pretty good. So I think as part of like your overall semiconductor portfolio, I mean, I appreciate the quality of the company. It trades a little bit expensive, but deserves it. You have probably multiple maintenance plus growth. You get a sizable return. Yeah, it's close to $500. Yeah, if you got it, if you got it close to there, I mean, you're pretty solid. I think at this point you hold. I don't think you'll see that price again. So. Instruction to clear what is Google. Only boomers use Google. Use Google. Oh, you guys are funny. But anyways, so that's the conversation I want to have about the September slump, and maybe because everyone's talking about it, it won't play out as much as people think it would, and it's going to be a bit chaotic. You're going to have people playing with the soap, potentially the data center plays, the semiconductor plays. They're going to be positions of strength. A lot of people might be shaken out of them, and you'll see again. This is what happens when you play with the soap. It's best just to create a thesis, stick to it, buy it, hold it. You can make readjustments, you can reallocate, but for the most part, owning good businesses over long periods of time proves out as a strategy. If you want to sell everything and wait, I don't think you're going to do good over the longer term. I think that's a bit too emotional. So I would say you can reposition, depending on what you want exposure to, but saying I'm out of the markets, now I'm in the markets, or you're out of the markets, you want to wait for time to get back in the markets, problematic long term. Y'all know we are using Google right now, right? Yeah, you're fighting them all, right? So I gotta say, I've tried GPT, and GPT is not as good as Gemini's. Gotta say, it's fine. It's just I don't feel it's as good. It's because Google has tools that all meld together a little bit better. And I did like an experiment where I was trying to book a flight with the GPT and the what's the other search engine that you got to pay for? It's and it uses GPT, and it's like upgraded GPT. I forget the name of it, but yeah, there's another one. Gosh, how come I can't remember? No, it's not Claude. No, it's another one. No, it's not Microsoft Copilot, which is basically GPT. Perplexity. Yep, that's the one, June. Perplexity. So I used Perplexity. I tried it on GPT, and no, I didn't try it on Llama, but Jacob. So none of them did as well of a job as Gemini Advanced did, which I think is in part due to Google's other tools that are integrated into Gemini. So it was able to basically recommend flights for me to purchase, like specific ones, and give me links to buy them because it has access to Google Flights, as an example. And then I tried, with various other questions and queries, and most of the time I have found that Gemini Advanced is better than the counterparties. So I actually tend now to use Gemini Advanced. So, and I'm talking about the paid versions of each, by the way. So I'm not talking about, yes, it has. If you go on your phone, I shouldn't be, I'm basically promoting Google now. But no, if you go on your phone, and I do use it for proofreading things for me. If you go on your phone and you download the Google app, not the Chrome app, the Google app, it's right there. You can just pull up Google and just use Gemini. So yeah. And you can ask it questions, random questions. That's okay, June. Me neither. I'm not a good speller. So it does have an app. It's not like a Gemini app, but it's the Google app, and then you have the Gemini search, and you basically just interact with Gemini. And then if you have Gemini Advanced, it automatically will have Gemini Advanced. So I'd honestly argue that in that case, the marketing of OpenAI is a bit better because Google doesn't have maybe there's much namesake. They should honestly just apply it to Chrome in the same fashion that they have it for Google. I actually don't understand why they're not doing that. So Google should create a separate app. I find it more user friendly, in my opinion. So do you have the Google app? Because I feel like it's basically the same thing. You just click at the top and you say Google or Gemini. So you have Google Search or Gemini. I mean, and then once you're in Gemini mode, it's basically the same thing I find as the other ones. And you can talk to it, share a picture with it, or just type a question. And one thing I will note, if you guys looked at the Apple demo, the whatchamacallit, one of the parts where it was like they use Google search. And I was like, that's kind of funny. So when they did the image search on the bike and it showed where to buy the bike, it was using Google, and they even said utilizing Google. And I was like, oh, that's interesting. So I use ChatGPT app because it goes straight to it, but maybe I need to use Gemini more often. I mean, I just got to say, I find the paid version of Gemini to be more useful, at least for the things I need it for and the information I need to get. And I find it does hallucinate a lot less. Like as in, I actually haven't caught it hallucinating. It will more often, if it doesn't know what the exact answer is, it will just refer to me to sources. While I do find that ChatGPT has, and in the past, hallucinated and just given me wrong answers. So I've caught Gemini in Gemini Advanced in some quirky little incorrect points that I have to go back and be like, wait, why did you say it this way? And it's got to be like, oh, I'm sorry. I didn't mean it that way. But I found that GPT does it a little bit, not a little bit, actually more often than not, but it does it often-ish. So I find they all hallucinate like crazy. So annoying. Maybe for the tasks or the questions you ask it. I do find for the question, at least I ask it, which is, on various topics of conversation. Often I ask it to find things on the internet for me and search different statistics. I find that Gemini hallucinates less, or a lot less. Like if it doesn't know, it just says, here's like a link to search into it. Yeah, exactly. This is how honestly it feels sometimes. Pro, the paid version. I'm a bit problematic right now, where I'm paying for multiple LLMs. But I'm gonna stick to like Gemini Pro or Gemini Advanced, not GPT Pro or Plus. But I'm getting them all confused now. Use LLMs for reasoning more or info lookup? Info lookup if it's like for various like academic topics. Sometimes I asked it to solve some math equations for me, some math formulas for me. They've recently introduced Gemini Advanced for your Google Sheets, which I find sometimes helpful for helping me formulate a complex formula. I describe what I need it to do, and if I have most of it already down, it can kind of figure out maybe something I can do to make it simpler. But you got to work with that one a lot. It's not as easy yet. Maybe in the future, they'll be able to have it where someone who's not proficient in Excel / Google Sheets can just go on there and just ask it to create these, very nice formulas, if ands or ifs, like a series of ifs that all connect into something. So where you have like a lot of automatic calculations, but it's tough. Early, I found Gemini to make stuff up more than GPT. Well, Gemini Advanced, I feel like doesn't. I don't know about the regular Gemini. Gemini is so good with finding flights. Yeah, no, that's another thing. So that's what I'm saying. Is like it feels like Alphabet, if they do this right, they have a lot of tools they can kind of plug in. and make it really robust of an ecosystem. LLM market research. I don't know about that. I don't know if I'd trust them entirely just yet, but yeah. Your regular Gemini is actual broken trash. I mean, yeah, if you're not paying for it. That's where I think Llama comes in. I mean, well, Google is doing a lot of interesting things behind the scenes where we as the customer don't interact with them. They're actually monetizing their AI tools. There was a conference that they had recently, and it was a very interesting conference to learn about all the things about Google Cloud that they're executing on. So if you're kind of wanting to learn more about what Google Cloud is doing, I recommend that conference. I think it was hosted by Morgan Stanley. It was Morgan Stanley or Barclays, but I think Morgan Stanley. And they're actually monetizing a lot of their AI tools. So it'll be interesting to see what that comes about, but that's going to be more so on the enterprise side rather than the consumer side. So isn't no AI answer 5x the same as 5 hallucinations? I might be like slow right now. I don't understand what the comment. Knowing Google will probably take at least 30 more versions to get it right, and then it'll just be scraped as usual. I don't know how Google can afford to give away their top model for free with a usage cap when OpenAI gives away the top model for free. Well, I believe they're not affording it. That's why ChatGPT has a profitability concerns as of late. John Chris, my company just adopted Salesforce, $30 billion. I'm assuming your company is a $30 billion company. Yep, and it's going to be a very sticky product. Goo value trap or true value. Not scared of search share loss leading to rev decline long term. Could be offset by Gemini and Google Cloud growth. Well, I think Gemini, question mark. Google Cloud, not so much a question mark. ChatGPT is pretty cool. I can upload a chart screenshot and it can analyze it pretty well. Natural gas is an AI play. I mean, maybe. No. All these LLM tools in the future, I think I'm really bullish, like what they're going to do for productivity. There's a lot of improvements, especially for skilled labor. For unskilled labor, more bearish, but just there's going to be adaptations that need to be done. So someone who knows what they're doing will be able to do a lot more with less. You don't need as many assistants. You don't need as many grunts, as they say in the industry, doing like menial tasks. You'll be able to do them all or pretty quickly on your own, or assign it to something. But I'm pretty bullish on productivity. You said you get no answer. Isn't it the same as 5 hallucinations? No, but I prefer no answer than a hallucination, as in telling me the wrong answer. Because at the very least, you tell me, okay, this is like where you should probably investigate this, or you just don't know. I prefer that, especially if I'm trying to get information out of something. So it's like, would you prefer that, let's say, hypothetically, you got an encyclopedia. Would you prefer that it didn't have the information you were looking for, or it had information that's wrong, and then you went out into the world and acted on that information? I'd probably just prefer it not to have the information, and then I'd continue my search elsewhere until I find that piece of information. So I think a hallucination in terms of like making up an answer is way, way, way worse than not giving you an answer. So and then that's like on the averages, because you can probably be aware, but then why use it at all? Because you'll have to know the answer before you use it, because then you can't trust anything it gives you. So the only way you know it's making up an answer is if you already know that the answer it's giving you is wrong. And you're like, but you already know the answer then. So then why are you even asking it? Or at least ChatGPT made me lazy. I'll sometimes ask it to write code. I know to write and go make tea. I mean, if it's helping you do your job faster, And if it's helping, like, let's say maybe you had someone else write the code before, well, maybe you don't need that person to write that simple code. And then you're just proofreading like you would, your people below you. Could you help do a two? And it's kind of looking at liquidity, burn rate, debt rate level of Spirit Airlines to determine how likely the company might go to bankruptcy versus turnaround. Oh, I can already tell you because we looked at it. I think they're going bankrupt. I think it's good that they're going bankrupt. So, Hans, the reason I know from before is because when I was testing, like how many times they were giving me the wrong answer, I would see that and I would verify each and everyone's response to me. So we're talking about when I was like testing between each one. And so when I would ask like ChatGPT something, I would find that it kind of just made up an answer. And then when I went on Google and I searched for it, I found various sources countering the opinion of what ChatGPT gave me. And when I did the same search on Gemini, I saw that it was matching what I already searched on Google. So I was like, okay, that's fine. Or in some cases, when I saw it said, I don't know, I can't answer that question. I can't find the exact information. Here's some sources that might be. So like if you ask it sometimes like, oh, what's the current market share of blah, blah, blah in blah, blah, blah. You might say like Elf Cosmetics in the United States. And it should give you something from maybe like Nielsen or from Elf's own public reports. And you should know more or less where it's at. It's like, I think like 10, 12%. And if it's hallucinating, maybe, I don't know, it throws at you like 15%, something like that. Or a wrong answer, I'd still conclude it as giving you an outdated answer, which actually sometimes Gemini has been guilty of that, giving you a little bit of an outdated answer, but it will tell you the date. So then you can look at that and be like, oh, that's kind of wrong. Like you're right for that time period, but you're wrong in terms of like the context of what I asked you, because I asked you the current and you gave me Q2 of, I don't know, 2023, and we're already in 2024. I would like the 2024 figure. So I would consider that a wrong answer, and I caught it on something like that. I forget what company I was looking at for market share. But it gave me the right market share for the time period, wrong market share for what I was asking, and then GPT made it up. It gave me a wrong one entirely. Oh, I think there was one with Starbucks where I asked what percentage of Starbucks is in China. That one was another made up one. It was interesting. ChatGPT is the reason. No, I don't think it's the reason for that. We're not replacing people like that yet. Hello, all. All right. With that being said, I think we had a good time here. If you had to be 100%, would you just go S&P 500? I think if I had to, there's a lot of, they're all fine. As far as like, as long as you're getting a broadly diversified index, I think that's like the intent and the goal behind that. So yeah, VU, VTI, BT, more or less, it's going to be, when you're doing that strategy, it's going to be more about your savings rate than anything else. So yeah, save as much as you can, invest as much as you can, and you're done. And a lot of this outsourced, but J&J pays salaried well. You try Gemini and GPT, but you have to try Bedrock. Oh, sure. How much is it? I'll buy it or pay for it. Yeah. So I think like the future for these LLMs, if they're going to be ever used inside, is like you need to have a trust of the data, and like it's got to be contextualized within the data that the company has. So there's got to be a huge element of trust between it. Mark Benioff's talked a lot about that, and I haven't seen them truly move in that direction where they've come out with. I haven't seen the product, but maybe they are working on something. Whoever can figure that out, Microsoft has a good chance of getting that all of them do, I think, but figuring out tools that can both provide a lot of, like siloing of the data, making sure that it's not, other people can't get access to it. And where it's only the company that is using it with that data that they're giving it can utilize the LLM to look at said data. But again, that it cannot go out into the world and other people can have access. That would be terrible. That would be what they don't want, which is why a lot of organizations would never even use this in the first place, because right now, as they exist, you're giving the entirety of the system access to the data that you provide it. So like, if you're putting company code into it, there's a reason why companies don't want you to do that. So, any chance I response to my question above the survey? Can you repeat your question, Hans? I might have missed it. I'm sorry. Damn, that's terrible. Fabio, have you looked at Unity? Oh, Unity game recently. Terrible management, M&A led the stock to tank. Still the quasi duopoly with Unreal Engine and the potential turnaround, or not with bottom fishing. I haven't looked at Unity, although from even before, I thought that Unreal had a better positioning within the overall gaming ecosystem. Unity had a huge blunder. I mean, it is a really bad blunder. They really lost the trust of the developer community, the indie developer community. So going forward, I mean, I don't know if I want to bottom fish for that company. I can try to take a look at it, in the coming days, and maybe next time we go live, if you ask me again, I can have something more refined. But as of right now, I don't have an opinion one way or the other. I type slow, no time. Oh no. Okay. Well. Unreal Engine too good. RE Engine is peak though. Yeah. Unreal Engine is what everyone says you want to use. All right. It's a lot cheaper than Unreal. Okay. Yeah, for shorting in general, I've made money, but against me it was 10% realized loss. Oh, Fabio, thoughts on price of below 70. Oh, we actually just talked about this today in the club, funny enough. Huh. Rob, I have not tried Claude, the premium version of that. Okay. Do you think the yield curve will continue to uninvert? It has to uninvert at some point. And we're having okay, this is a fun prediction, so don't put money on this, but like the fun prediction is yield curve probably uninverts. Yeah. And we see a rate cutting cycle from the Fed. We see, I'm going to be vanilla and say the expectations are correct. We see 75 total for the year, 50 now, 25 later, maybe more. And for oil, we actually spoke about that today and the weekly call for the club, which, by the way, if you guys are interested in joining the club, the link is in the description below. But in today's weekly call, we had a great back and forth between one of the members and myself around energy, where it's at now, the positioning of it. And long story short, there may be a case of why energy might have near-term bottomed. There may be a case for it. There's, I think, there's like a fork in the road and two ways of looking at it. We could be in for demand destruction, and hence why energy is collapsing. But there also could be a lot of lack of, let's call it, perception of demand, and that could be actually leading contract prices to, or activity among contract pricing to go down a lot. And we might be at a low point for international, it's not storage. What's it called? Oh my gosh, inventory of oil. And so that inventory probably needs to be filled back up at some point. So that could be the catalyst that causes energy prices to go up. We had also OPEC decide that, demand's too weak for them to increase production. So they're not going to increase production. This again could be another potential catalyst for pro energy team. So it really does depend on where you think or how bad you think demand destruction is going to be. If you think it's going to be really bad, which is, still negative economy in the near term, but it's also self-healing because energy coming down because of demand destruction is in and of itself a positive force for consumer demand in the future, because you have input costs come down. Energy is one of the primary input costs. And with energy going up, you had a lot of cost push inflation, not really demand driven inflation. But with cost push inflation kind of going away with the price of energy coming down, this presents an opportunity for the consumer to heal, so to speak. Remember that energy prices going up, it's a drag on discretionary spend. And with discretionary spend dragging down, that brings down the consumer economy. You see that with all these companies that we're talking about, Dollar General, Walmart, et cetera, all of them kind of having these different discussions about trading down. Walmart's doing fine, but Dollar General is doing poorly. Dollar Tree is doing poorly. Listen to companies that spend or have a lot of reliance on spend for the discretionary, and they're not pointing to a strong consumer. Academy Sports, Dick's Sporting Goods, on and on and on, really. So if that happens and you're concerned about that, I think that the demand destruction narrative, oil coming down further, is going to be something that helps in the future. But if you think it's bottoming, and you might look at energy plays, what we were discussing is different strategies to capture that movement with a smaller percentage of our portfolios. So there is a scenario where if we see like an energy pop, you could take that profit from it and then take the profits and then maybe buy into your favorite longs in like 6 months from now if energy is bottoming, because some energy names are really in pain right now because of this perception and belief that energy might go lower. And as my co-host Andrew said, I think 3 live streams ago or so, the tendency of the current perception is whatever the current situation is and extrapolate that forever into the future. And then, the joke of it's always priced in, kind of. So whatever is the current phenomena or observational reality, you take that and then you extrapolate that and say that's the whole future. And that's a lot of times what market participants do. People do it all the time. Where bad times, there'll be bad times forever. Good times, there'll be good times forever. Energy's down, energy will be down forever. On and on and on, which I don't agree with. I don't think anyone here agrees with. Okay, so I see your question, Hans. MS return over 25 years, less than market return. I think MS is Microsoft, I'm assuming. You needed cloud and AI that were never in the thesis to get its current return and not be Cisco. Yeah, definitely you're talking about Microsoft. Growth is overpriced for long growth. So CrowdStrike. We talked about CrowdStrike in the last live stream. Please advise my dog to buy more CrowdStrike. All right. Well, with CrowdStrike, I feel like we can wait a couple quarters, was the conclusion from the last live stream. We can wait a couple quarters to see how things play out. What's CrowdStrike trading at now? I don't know if it's fully recovered at all. So 253. So it's basically gone nowhere from the last live stream. In fact, it's gone down from the last live stream. So there's still a bit of uncertainty that we can kind of be patient for. I don't necessarily think it's a rush to the door. We know it's a fantastic product. In fact, Andrew was quite long for quite some time. He had a very Let's call it. I was very jealous of his cost basis and his allocation. I think I had the same cost basis as him. I still hold my pitiful allocation, but because my allocation was pitiful, Andrew had by percent basis a much better allocation at a roughly the same, I think, cost basis in the 90s. And I mean, it had done really well. And he actually did capture most of the upside and skipped most of the downside, because he did sell it around like 300 or so. But point being is, like, in this channel, we're not enemies of CrowdStrike. We think it's a great company. It was a huge blunder, but I don't think we've seen, and what we talked about in the last week live stream is, I don't think we've seen the full consequence of what occurred. So no rush for me, at least, to dive in. But okay, so for Han's question within the statement, which I reading it as a question, is like, do I think Google will be Microsoft? No, I mean, not really, because the thing with Microsoft is Microsoft software had grown into its peak, and the valuation that Microsoft was trading at, I think I can bring this up here. So I think this is the missing context, and I'm going to take a current PE of each period. Okay, so this tool will not go back far enough from what I want, but this one will. So I'm going to go use this one. So select metrics, valuation, per PE gap on a current basis. It's loading through. And then I think we can do price as well. I'm not sharing my screen yet. Don't worry. I'm just getting ready for you guys. Okay, so I think this is the missing context. Oh, sorry. So I pulled this up, and what I'm basically trying to make a point here is, I think Google and Microsoft, completely different setups. So back when we had that issue, the valuation that Microsoft was trading at, it was out of this world. And we're looking at it on a current PE, not a forward PE. It could have been that on a forward basis, Microsoft was trading at a better rate than over 300. I think it was, because I don't think sell side was like too off the mark. Maybe they were crazy optimistic. I don't know. I'm not going to make any presumptions on that. But looking at it, taking a step back, what I'm observing here is that Google of today at a 21 current PE and a 17 times forward is very different from a Microsoft at 300 plus current PE. You can see the peak. So you see the price and then the multiple. And then preceding that, it basically had multiple contractions. So you were in 2004, when the price was $25.57, you were paying 25 times earnings still. And what I'm seeing here is earnings were growing, but what you paid for it was so egregious that the multiple was just contracting. That's all that was happening. So here we have they're too close to each other. That sucks. Yeah, there it is. PE of 10 at the bottom of the market, which was around 2011. PE of 10 and a price that was basically the same as it was all the way over here in 2004. So all that you had was just multiple contraction throughout that period, because the multiple was starting off at an extreme point. And here the multiple fell because the stock price fell, looks like. So the stock price went from, what was this? 26.75 so basically cut in half, let's call it. So that was cut in half, and the multiple was cut in half. Tells me earnings actually didn't grow that much. They grew, but maybe not by that much. So I get what you're saying, and a lot of people are equating it to Microsoft, except I think it's totally different setups. Totally different setups. Call me wrong, and I'd love to kind of go back and forth about this, but I don't think, or I don't see Microsoft and Google just looking at this. Doesn't make sense. I'm not using forward estimates because forward estimates are subject to change. I'm just using current, and on a current, to simplify things, it's completely different situations. So if someone's buying Google right now, I wouldn't say that it looks crazy overvalued, but I bet that I would still be one of those people, because I know I'd probably be one of those people, because during like 2021, I was one of the YouTubers making videos about why people are absolutely insane. So probably if we were making YouTube videos back then during the .com bubble, we'd probably be saying the same thing, or something a similar nuanced approach to it. But you guys are probably insane for, first of all, buying revenue, like companies with no revenue whatsoever. The SPAC craze, I mean, we saw that was the case. There was a lot of excitement around SPACs, and a lot of YouTubers making videos about SPACs, still to this day making videos about the same SPACs. Did Microsoft have the same gross margins as Google? We can add that metric. Gross profit margin. So right here, the gross margins were, now you see, like, this is noise on the graph. This is amazing. All right, but we have to kind of use a little bit of our mind to track this. 80%. It looks a lot bigger of a change than it really is. Like, it is a big change, but it's not that crazy. So at one point it was above 90%, and then it fell. Oh, you see, this is the annoying part. So 86% at the highs, and then right here when it had already fallen by quite a bit and the multiple had fallen, that's still in the 80s, 85. And then here at the low of 2016, because they had a new business that was growing, 61%. But there's a lot of context as to why these gross profit margins declined. So, and I do believe it had something to do also with their product mix was changing. But yeah, their gross profit margins are definitely down. And the gross profit margins for Google, they are not at this level. So let me see. I can pull it up on the side here to get an exact, tell you the exact percentage in a sec. Give me 1 second. I just want to be precise. It's 57. Okay, so it's 57.64%. So, and I agree with what Sam said. Not a good comparison to do, but I did it just for the request. So, yeah, but I hope this puts some context into this, that I do not think that the Microsoft situation was the same. On an earnings growth basis, it looks like they didn't grow earnings that much, and you were smoking something that I do wish you could give me the contact for, because I'm not saying you actually did this, Hans, but I'm saying people paying over 300 times earnings for a company like Microsoft. And then people wonder, why did it underperform for 25 years? Well, I wonder what you did. What did you pay for it? So, because recall that a lot of people even say that during this dead money period, Microsoft as a company was doing great. It was doing a lot of good things. Profit was going up and up and up and up and up. But I mean, I love that we brought this up, because I mean, this is really telling. I mean, you have for a while, like, you're trading 40 times earnings still in 2003. This is post.com bubble. And then over here, you're finally trading in this low period. That's like the crisis period. But I mean, geez, right up until 2008, you're still paying, 20 plus times earnings for it. And the earnings growth doesn't seem to be growing all too much. So, and all that's happening is just the multiple is contracting. The multiple is contracting. My goodness, this is crazy to think about. But yeah, you could have bought Microsoft at 9.87. So that also shows you that, yes, at one point in time, a low multiple stock, Microsoft, was a low multiple stock, because this is on a current basis. So I'm saying on a current PE, Microsoft was trading at 9.87. Also really shows you how bad it got. So will you get an opportunity like that again? Maybe. But 2008 was a very strange recession. It was not normal. And people have a recency bias with it. We talked about that a lot today in the club. It was a lot of people associate recessions with 2008, and they think, oh, we're going to have a recession. What is a recession like? 2008. That's what recessions are like. No, that is an extreme recession. We've had two extreme recessions that we can point to: 2008 and the stock market crash in 1929, the Great Depression that followed right after. Those are the two. And then you look at, if you read testimonials or accounts of people who lived back in the day, you might remember, or you might be shocked to learn that, and you might have studied this if you took an economics class, but the generations that followed and lived through the Great Depression were forever scarred, as in their behavior was changed forever. So the people who lived during that, their consumer behavior was different, even throughout the 1950s. They had a greater propensity of saving, as an example. And then their kids who never lived through that, they had a greater propensity for spending, which was good for that switch to happen, because we had then a whole new era of booming consumerism. But the generation that lived through the Great Depression, they never spent like they ever did back in the 1920s ever again. They were a lot more on the saving side. And it wouldn't surprise me that people who, there's probably already studies on this, but people who lived during 2008 in their working life still remember that to some extent. It's probably affected how they conduct themselves in life with real estate. So for example, maybe a lot of people, and you might know someone in your life who's like that, they got burned with real estate and they have like some sort of scarring with real estate, where they don't view it as an interesting of investment as you do, who haven't been through that. So they might be more skeptical of it. And I'm saying, notice maybe you are not, because you haven't lived through that. So you didn't know what it was like. Yeah, June says, war does that to you. So in that way, like financial war can do that to someone. But anyways, great conversation to bring up, and good to bring this up as a comparison. I really like it. Why doesn't Amazon do buybacks? Buybacks are a return of capital, and you only do return of capital when you've exhausted all attractive reinvestment opportunities. Buybacks and dividends are both forms of return of capital. Great question, Boba the dog. Right. So let's say I'm your management team, and I have a lot of projects in front of me that all give us, I'm going to make up a number, 20% return on investment. So if I put a dollar in there, I get $1.20 back. And let's say it's reliable, it's secure. So I can do that. And let's say the shares on the open market, they're trading at, and we're going to do on an earnings yield basis. They're trading at 20 times, so 5% earnings yield. Okay, Boba the dog, I'm going to give you this proposition for you. You're my boss, right? You're the shareholder. And I say to you, okay, Boba, I could grab all this money that we're making and I could throw it into these projects and we can generate 20% return every time. Or I could buy back stock for you and we could get a 5% earnings yield going. And yeah, maybe, would you be happy for me to do that? And then conversely, maybe I don't do buybacks and you're like, what is the other option? I'm like, I could give you a dividend. I instead of putting all this money into this projects that have 20% return, I give it to you as a dividend. Do you want that? And then maybe you ask yourself, can I reliably get 20+% rate of return? You see where I'm going with this? Like, that's the question you have to ask. So why doesn't Amazon do buybacks? Well, maybe because Amazon's like, and rightfully so, thankfully, their management team is like, we have maybe all these projects over here that can generate a pretty good return on investment. That why would we buy back the stock? The stock is trading at what? 50 times current earnings, but even if we do cash flow, it's less, but I don't think it's like, anywhere near the return on investment they're getting on their projects. I think that the return is, maybe like 5-6%, maybe. I'd have to see exactly what the free cash flow is, cutting out growth capex, but it's probably not what you think. It's probably less than reinvestment. So the reinvestment runway is still quite large. So basically, the cash should only be given back to you if they've exhausted all available avenues, and then each subsequent dollar starts to have a lower and lower return. So then you start to say, if the next dollar I invest in is only going to generate 10%, maybe it's time I give it back to you, right? Because you can probably generate okay reliability 7% return. Let's just say 7%. So if the net new dollar invested is a 7% return, I definitely should not be doing that, and I should just be doing buybacks and or a dividend. And then the buyback argument will depend on what the valuation the share price is at, because maybe a dividend is a better option. So yeah, but blind buybacks and random rinky-dink dividends, I don't like them. I like dynamic movement of capital, dynamic allocation of capital, flexibility in the allocation of capital. In a perfect world, you'd have a fantastic CEO at the helm and a CFO at the helm who are looking at all available opportunities, exhausting those great opportunities, and then after that, they're so nice and loyal to you that they think about you and they say, hey, how can I return this capital to you in the best way possible? I.e., our stock is trading at 10 times earnings, so it's a 10% earnings yield. We should probably buy back stock, maybe as an example, or maybe even less, like BTI. And instead of paying a dividend, which a dividend, sure, you're happy with your income, but I could delete shares and you probably have a much better return longer term. And then let's say the share price or the multiple expands, and then I switch over and say, oh, no more buybacks. Now here's a dividend. Perfect world, perfect. That'd be the ideal management team for me. I've ranted about this before, but here's a stock that I wish would stop doing the dividend and they did buybacks instead. For full disclosure, I own BTI. And we've done really well in BTI. This has actually been a flight to safety stock. So we have a pretty good yield on cost. But around, I think it was here-ish, somewhere, I forget the exact live stream date, but I did a live stream roughly around here. And I went over like on Twitter. I tweeted about this. And I wish that the management team at BTI would have stopped the dividend entirely. It makes no sense. Even now, it's not too late for them. It is not too late for them. No more dividend. Cut it out, 100% of it. I don't care if people get sad, upset. They're like, my income, oh my God. Cut the dividend and switch all of it to buybacks. All of it for the time being. They would devour the share count like nobody's business. You have no idea. So I'll say it this way. I say this to the club members all the time. I have never seen... Maybe someone could show me one because I've never seen it. I've never seen a last man standing scenario. When I mean last man standing is you buy a stock and they're trading at a cheap multiple and then they're doing crazy buybacks. And by the time, time passes, you've become the largest shareholder by far. Never seen it happen. You know what usually happens? The stock price goes what? It goes up. The multiple expands. Because the market, there's no such thing as free money like that. That would be the equivalent of that. So if they did that, I probably guarantee you that BTI upon that switch would become one of the highest returning stocks in the stock market for the foreseeable future as long as it traded at a really low multiple. It wouldn't continue to trade at a really low multiple. It would expand. 100% it would expand. There's zero chance. I say that as a statement of fact, by the way, which I think there's very rare times, but barring the profitability of the company deteriorating rapidly, I guarantee you, as a statement of fact, if it traded at 6 times earnings for a while and committed all of what they currently do for dividends, plus what they did as buybacks, and they still pay down debt, did all of that towards buybacks, statement of fact, guarantee you it would outperform a huge majority of stocks in the stock market. And the multiple would expand to a point where then they could switch over to dividends at that point. And your payout ratio, if you just reinstated the exact same dividend payments, your payout ratio would still be like incredible. It would be way lower because you would have deleted the share count. But anyways, that's neither here or there. That's neither here or there. It's a shoulda, coulda, woulda thing, and they didn't do it, and that's a ding on them. But this is an example of like where capital allocation really matters. And if you had amazing capital allocators at BTI, you could have had greatness, but you don't. You have pretty goodness. It's pretty good. Not great, but it's pretty good. So. And I agree with this. AWS has a way better return on invested capital than buybacks. Exactly. The runway hasn't run out. So don't give me the money. Keep the money. Do what you need to. So these are all companies where we're talking about they shouldn't give. This company is completely different situation. That's why I was bringing it up, Boba the dog. This is a company that I don't really want them to keep any of the money. You know what happens when they keep money? You know what happens? I'll give you the company that is a perfect example. This is what happens. Altria, this guy. This is a company that had the dumb management team that went out and burned, I think, like $12 billion. Like they lit it on fire. They grabbed money. Well, they didn't even lit it on fire. They threw it down a hole. Because if they at least, like I always say, if at least you light money on fire, you get a benefit where, you're getting heat from it. Like you're getting something. But if you throw it down a hole, which is what they did, you get nothing. So they just burned it through acquisitions. These are companies that should not keep any of the money. They should be doing buybacks or dividends. No ifs, ands, or buts. No in between. That's it. All right. I hope not right now. I think it's too early. The only reason Altria has been able to maintain its dividend growth over several decades is the buybacks. Precisely. They should only be doing dividends or buybacks, though. My point is they should not. Yeah, they shouldn't keep any of the money because when they do that, they do Kronos Group, which Blake, you'd appreciate that how much of a blunder that was. Kronos Group and Juul. What happened to both of them? One of them was written off to zero. I think both might have been written off to zero because they're both worthless trash. Those terrible investments. That's what happens when you have this kind of company. And they don't just cash cow it to you. The Bud Light one, though, is fine because the Bud Light was through a sale of a non-core asset. That's actually okay. That wasn't that big of a deal because they had an ownership stake in an alcohol company that Anheuser-Busch purchased. But that one's fine. That was a divestiture to focus on the core assets. I kind of say A-okay with that one. They didn't purchase Bud shares outright. But the other ones they did. That was so stupid. So anyways, enough ranting. You guys caught me on a bit of a rant there. But I wanted to show you guys an example of a company that, or go through the conversation of why Amazon shouldn't be doing buybacks right now. Or at least like, I don't think it's a good idea, but an Altria Group, that's entirely what they should be doing. A BTI, that's entirely what they should be doing. So you see the two examples. Massive reinvestment runway, little to no reinvestment runway. Cash cow company versus company that has, very bright, untapped future still ahead of it. Alexandra Gill. All right. With that being said, guys, you can charts do an Apple buyback return. Oof. What can I charts do that? No, but the earnings yield's been pretty low on the recent ones for sure. All right. With that being said, guys, thank you guys so much for joining us in today. If you guys liked the live stream, feel free to leave a like, share, subscribe, comment down below. I stuck to the timestamps for the most part. And if you're on Twitter, like it as well. If you liked it, retweet it if you want to. On Twitch, do whatever you do there on Twitch. Also, if you guys are curious about the investment club, the link is down in the description below. But with that being said, thank you guys so much for joining, and I'll be seeing you guys on the next time.
Okay. We'll do it live.
Okay.
We'll do it live. It. Do it live. I'll write it and we'll do it live. F***ing thing sucks.